folks, we are back at it again, looking for 2 dividend stocks to be adding to my 6-figure portfolio, and the sectors we are going to be focusing on today are going to be the financials, which currently makes up an 11% weighting. And I told you guys that I was looking for 1 new bank stock to add, and then in the other sector we're going to be talking about the consumer staples products, which currently only makes up a 6% weighting, primarily thanks to Pepsi. So what I've gone ahead and done is I've taken the earnings reports from the top weighted companies in both these sectors so we can do a side-by-side comparison and then finally figure out what are the best 2 that I should be adding today. So in the clarity of my transparency and the homework I do for you guys, if you don't mind, smash that like button and let's jump right into this. Investors alike. So to kick this off, what I've gone ahead and done is based on these 2 sectors we're going to be analyzing with the financials and consumer staples products, I've taken the top weighted performing companies and have done a side-by-side comparison of their most recent earnings reports. And once we get through these, we're actually going to take a look at the performance charts along with the dividend yields to figure out what one is going to be best suited for my 6-figure dividend stock portfolio today. Now, starting this off, we're going to be taking a look at the financial sector with the Canadian banks on the top and the US banks on the bottom, and this makes it crystal clear to see what ones are better on the earnings and revenue side, with clearly Bank of Nova Scotia being the worst performing Canadian bank so far, continually on a downtrend, not only with its revenues but its earnings. And I already own Bank of Nova Scotia, so I'm feeling some of the pain, which we'll see when we actually take a look at the performance chart. But the best performer by far would have to be a comparison between RY and TD, but just based off the bottom line earnings, Royal Bank is definitely the better performer here. But it is the largest company in Canada, and they're doing a pretty good job through this pandemic here, with obviously Q2 of 2020 being the worst performance period for them. And next to that, I'd probably put Canadian Imperial Bank, that's been very stable, with TD probably being the 3rd best performer, but they all have their pros and cons, and they all seem pretty equally weighted except for Bank of Nova Scotia. Now, taking a look at the US side of the border here, folks, with the largest banks being JP Morgan and Goldman Sachs, they both have been fairly leveled, with Goldman Sachs having the best revenue performance. With JP Morgan, these guys are almost back-to-back comparable here, so I'd probably put these 2 in an equal weighted basket, with Bank of America being my 3rd pick here, but obviously Bank of America being Warren Buffett's favorite. It's kind of neat to see how all of these are following a very similar suited line. So I don't know of these what one I could say is better or worse technically, because they all generally look exactly the same. So just getting into these performance charts, guys, to see what ones are trading at the best discounts, I'm going to have to put Citigroup at the very top of the list, currently paying out a 4.67% dividend yield, a PE of 8, and trading down 46% year to date. It is going to be on the top of the list, I think, for US buys right now, just because of how stable their earnings and revenue are. It's got to make the top of the list just for the basic discount that it is trading on, with one that I'd put next to it being Bank of America, because it's one of Warren Buffett's favorites. It's trading down 32% year to date with a almost 3% dividend yield and a little bit higher of a PE, so you're paying a bit of a heftier premium, but you're also talking about one of the largest banks in the US, with next to that being JP Morgan, trading down 28%, a 3.59% dividend yield, and a little bit of a higher PE. We can see how these are itching up as the market caps do get larger, because I guess people put a higher premium on the larger banks, with finally being Goldman Sachs. You're only trading down 10.6%, the highest PE of the bunch, with 15.9 and a dividend yield of 2.39. This is one that I could not foresee anybody really wanting to add, saying that it is trading at a discount. It really doesn't matter how large they are, so long as they just have stable revenues and earnings and they're not completely getting crushed through this, and hopefully we can see a light at the end of the tunnel. These things are going to turn around beautifully. Now, moving into the Canadian side of the border here, folks, the one at the top of my list, which is the 3rd pick we mentioned, obviously being TD, is one that I am severely considering adding to my portfolio. They have been doing fairly incredibly well. It's one that I don't already own, and it's trading down 19.18% as of today, with a 5.3% dividend yield and a PE of 11.5. It's definitely going to be at the top of my list. Now, second to that, and the only reason that TD is at the top, is because I already own Canadian Imperial Bank. Now, this this one has been really stable with a higher exposure to Canadian real estate in the mortgage market. People were really concerned by that, but considering real estate prices in Canada are still going up, a lot of people are still paying their mortgage in this pandemic. It would probably be one that if you don't already own, I would put it at the top of the Canadian banks to buy, because it currently trades down 7.31% with still a huge dividend yield at 5.8% with a PE of 11.6. You know, it's going to be probably one of my top two picks here, with the third one being the Royal Bank, which is by far the largest company in Canada here, not trading at nearly as much of a discount. You'll notice the similarities right next to the US banks, guys. The larger those market caps get, the more of a premium you pay, with a PE of 12.3, a dividend yield of 4.5. I don't find this one nearly as attractive. I never really have, because it always trades at a higher valuation here. Now, finally, in the worst performer of the bunch here, being Bank of Nova Scotia, trading down 24% with a 6.47% yield and a PE of 9.8. It is one that I still wouldn't cuff off because it is trading at a fairly hefty discount. We just want to see some stabilization in those earnings and revenues here, folks. Now, moving over into the consumer staple products, this is where I'm a little bit more confused because I'm having a hard time figuring out what ones I should add to my portfolios. So once we get through these, I would love to know your guys' opinion on what one you think I should be adding. But taking a look at the top of the list, we got Kimberly-Clark, we've got General Mills, Pepsi, and of course Unilever here, guys. And just scrolling through these real quick, they all seem to be, for the exact reason I want to own them, unbelievably stable companies. This is by far one of the most stable parts of the market when we're looking for very reliable dividend income. I mean, look at Unilever here with unchanged revenues and a growing bottom line earnings here, guys. Unilever seems to be the most stable of the top bunch we're looking at here. But all in all, I don't know what to say about them because they're all incredibly stable. But at the bottom side of this, we're talking about things like Clorox. It will not be able to make my portfolio list because it is trading at such a hefty premium because they sell the cleaning products. If you were able to pick this one up going into the pandemic or any time in the first couple of months of the shutdown, I mean, that would have been the time to get your hands in it. But because it trades at such a high premium and because it's a growing company, the dividend yield has sank drastically. The PE is insanely high, and it's just something that I could not foresee me adding at this current moment to my portfolio. And then, of course, we've got Colgate in here. We've got Coca-Cola, and then, of course, Campbell's Soup. The only one that I would primarily be avoiding because it's the worst performer here is Coca-Cola. Many of you know I already added Pepsi to my portfolio, and we'll take a look at that one in a second here. But Coca-Cola has been getting hit fairly hard in this pandemic, guys, which is one reason. I know a lot of people like it. It's paying a much higher dividend yield, but I don't want to own a consumer staples that isn't at least stable or growing in this pandemic. So let's just take a look at the performance here along with the dividends, and we're going to take a look at the ones that I am most attracted to. At the top of the list being Kimberly-Clark with a 2.86% dividend yield, a PE of 20, guys. This is one that I am desperately waiting for a dip. If this thing dips and it ends up paying out a 3% yield again, I will be buying this one for sure. Kimberly-Clark is more or less focused on tissues, toilet paper, and women hygiene and baby products. So we're not talking about the food sector, but these are products that, again, guys, are going to be staples, absolute utter staples to society in so many major ways. So I really like this company. It's going to be on my radar for a little bit, and I'm hoping we see a continued sell-off, hopefully going into the election cycle here. And then second to that, one that I'm finding super attractive here is General Mills. And just taking a look again, guys, at these earnings with General Mills here along against Kimberly-Clark, we can see they're not like major growing brands, but again, guys, we're looking for stability in income and something that's going to take away some of the volatility of my stock portfolio. And just taking a look at this guy and we got a 3.32% dividend yield. It's going to be on the higher of the dividend yielders with a 16 PE. It's definitely a lot cheaper than your Kimberly-Clarks of the world. And this one has been getting a few negative headlines just primarily based off some of their products because one of their biggest brands are based off cereals because they got Cheerios, Lucky Charms, and a variety of other products in here. They got ice cream, some of the best brands like Haagen-Dazs. This is going to be in the food-based sector, and the only reason I haven't really thought about adding this till just now is because I was already primarily focused on Pepsi stock. Pepsi made it to the top of my list because they make some of my most favorite products in the food sector, and this is another one that I would put right next to Kimberly-Clark if it starts paying out a 3% dividend yield again, which is where I was picking it up on these last little discounts that it offered. But it definitely trades at fair value, a much more premium PE, and this also comes down to the fact that the larger the market capitalization of the company, typically the higher premium you're going to end up paying for. But I'm sure you all know Pepsi products. We've gone over these tons of times before, with some of my favorites being Doritos and Smart Pop, but they have a wide variety of a ton of other things, the whole 9 yards here, right? And this has obviously been one of the best performers of the bunch, just taking a look at the long-term charting, guys. If you don't own this one already, again, get it on your buy list and just keep an eye on it, because we're trying to pick these up when they're paying over 3% yields. Now, moving into the fourth one that I'm finding relatively attractive here, but one that I'm gonna have to do a little more due diligence on, is going to be Unilever, probably paying the highest yield of the bunch currently today at a 3.6% dividend and a PE ratio of 23. It kind of sits in the mid-range, but still a much more premium valuation. And just taking a look at the brands, if you've never heard of Unilever, this one kind of flies under the radar, but they produce products like Axe, Degree, Dove, a lot of beauty products. I mean, we also have Q-tips in here, which I don't know if there's any other brands that even sell Q-tips. I mean, that seems to be one of those staple products. And oddly enough, I just think it's funny that they got Hellmann's in here, so you are getting some of those food-based products. Vaseline, of course, another really popular one. Lipton, I'm sure you've heard of those, like iced tea products. Red Rose, a really big tea product. So I mean, this one's really interesting as well. And this is the problem that I'm having trying to figure out what one of these to add, because I think I should be putting Unilever right next to Kimberly-Clark along with General Mills. When we're talking about dividend investing, though, where obviously most of my attraction goes to the higher yielders, so I'm definitely kind of stuck with General Mills and Unilever at this moment of ones that I would considering picking up. And then again, if we see a dip, I would definitely want to add Kimberly-Clark. But taking a look at the last few, guys, the ones that I just can't foresee myself adding, obviously Colgate, Palmolive here, guys, because the dividend yield way too low at 2.2%, the PE ratio way too high at 26, and we could say the same about Clorox here, trading at one of the highest premiums we're going to see today with a 2.8 PE and a 2% dividend yield. Again, if you pick this up going into the pandemic, congratulations. I would just hold on to it, but unless we see some kind of a major pullback, it's just trading at way too high of a premium. And I'm going to say the same, obviously, with Procter & Gamble. This is one of my major regrets in my investing career, because I bought into this one about a year and a half, 2 years ago, and I sold out of it into this rally, in which I am ever regretting that decision right now, because I was buying it when it was paying out a 3% yield, at which today we're sitting at a 2.2% with a PE of 28. And again, also talking about some of the largest market capitalized companies in these sectors of the market. And then finally, in the mix of the bunch, we got Campbell's Soup here. This is one that I never really cared about. Don't really find it attractive. I really don't eat a lot of Campbell's Soup products. I still think you're getting some better deals when you're looking at General Mills, Unilever, Kimberly-Clark, and of course, I would like to throw Pepsi in there if it dips again. I just think it's one of my favorite in the consumer food products, which leads me down to a question for you guys. What one of these would be your favorite? I think I'm going to do a little bit of a poll on my YouTube channel, so when you see it come up, I'm going to be listing some of the top consumer staple products here that I'm just super interested in, and you guys can vote. I'd really appreciate it, or you can let me know in the comment section below. Again, if you guys can let me know what your favorite consumer staples products are, I'm still pretty confident that TD will be the one that I'm going to add as my new bank stock, because living up here in Canada, I like the tax benefits, I like the stability, and I still think the Canadian banks have always been slightly better than the US banks, because you got to consider here, guys, in Canada, they are not putting any restrictions on the banks when it comes to dividend increases, when we're talking about share buybacks, even though they're not really considering that. Whereas in the US, you got the Federal Reserve kind of clamping down their fists, saying, look, for the rest of the year, no buybacks, no dividend increases. So I've always kind of weighted toward the Canadian half of that market. But in light of all that, I'd still love to know what you think. So stay cool, stay awesome, and I look forward to catching you guys tomorrow.